Are you looking to buy or sell a home and want to save money on interest rates or closing costs? Let's talk about one of the real estate world's hidden gems, home loan assumptions. In this video, we'll break down what they are, how they work, and how you can benefit from them. Let's get started. So what exactly is a home loan assumption? Simply put, it's when a buyer takes over the seller's existing mortgage. That means the buyer agrees to continue making payments under the same terms, including the interest rate, repayment schedule, and the remaining loan balance. But not every loan qualifies for this, so let's talk about eligibility. The most common loans that are assumable are government-backed loans, like FHA, VA, and USDA loans. However, conventional loans usually aren't assumable unless the lender allows it. Now that we know what loan assumptions are, let's dive into how they work. Here's how the process works. First, the buyer confirms whether the seller's loan is assumable. Next, the buyer applies for approval from the lender. This includes meeting the lender's credit and income requirements. If approved, the buyer must pay the seller's equity. This is the difference between the home's current market value and the remaining loan balance. Finally, the lender transfers the loan to the buyer, often with lower closing costs compared to a new mortgage. Sounds simple, right? But like anything in real estate, there are pros and cons. Let's take a look. Let's start with the benefits of assuming a loan. First, lower interest rates. If the seller locked in a great rate, you get to inherit it. In today's rising rate market, this can save you thousands of dollars. Second, reduced closing costs. Loan assumptions often have fewer fees than starting a new mortgage. Third, the process can be faster and simpler if the lender approves your application. Fourth, the buyer gets to keep the original loan terms, like the repayment period and monthly payment amounts. But there are some drawbacks too. First, you'll need to pay the seller's equity up front, which could be a significant amount if the home's value has increased. Second, not all loans are assumable, so you'll need to verify this before proceeding. Third, lender approval is required, so if your credit or income doesn't meet their standards, you're out of luck. Fourth, for sellers, there's a risk of remaining liable for the loan if the buyer defaults, unless the lender explicitly releases them from liability. So, who really benefits from a loan assumption? Buyers. Especially in a market with rising interest rates, buyers can save big by inheriting a lower rate. Sellers. If you have a low-interest loan, offering it as assumable can make your home more attractive to buyers. Veterans and first-time buyers, FHA and VA loans are more flexible, making them easier to assume for eligible buyers. Now let's talk about how to actually assume a loan. Here's a step-by-step breakdown. 1. Check eligibility. Confirm with the seller or lender if the loan is assumable. 2. Submit an application. Provide the lender with your credit and income details. 3. Negotiate the equity payment. Work out how you'll pay the seller's equity, whether upfront or through financing. 4. Cover assumption fees. These are usually lower than traditional closing costs, but still need to be accounted for. 5. Finalize the transfer. Once approved, the lender will officially transfer the loan to your name. So, when is a home loan assumption the right choice? It's ideal when interest rates are high, the seller's rate is significantly lower, or you want to save on closing costs. Just make sure to consult your lender and a real estate professional to determine if this option aligns with your financial goals. If you found this video helpful, give it a thumbs up and subscribe for more tips on real estate and personal finance. And remember, with the right strategy, you can save big on your home buying journey. Thanks for watching, and I'll see you in the next video.